Hey everyone, and welcome. Today, we're going to get into something pretty advanced, a way to seriously level up your candlestick analysis. We're talking about plugging in signals from global markets to get a real edge. So, if you're an Indian trader and you're looking for that next step, you are in exactly the right place.
So let me start by asking you a question, and I think I know the answer. Have you ever spotted that perfect bullish setup on your chart? I mean, textbook perfect. You jump into the trade feeling great, and then crickets. Nothing. Or, even worse, it completely reverses on you. Sound familiar? So why on earth does that happen? Well, here's the thing. The reason for that failed signal, it probably wasn't even on your local chart to begin with. The real reason could be brewing thousands of miles away, based on what's happening in the US markets or how money is flowing around the globe. You see, our local signals, they're often just one small piece of a much, much bigger puzzle. Okay, so here's how we're going to break this all down. First, we'll talk about the global connection. Then we're going to look at three key signals you absolutely need to be watching: the Dow Jones, the Nasdaq, and the dollar index. And stick with me, because at the end, we're going to tie it all together into one powerful trading mantra. All right, first things first, why should a trader in India even care about what happens on the other side of the planet? Well, because in today's world, financial markets are all tangled up together. They're deeply interconnected. And if you ignore these global signals, it's kind of like trying to trade with one eye closed. You're literally missing half the picture. Now, this whole idea has a name. It's called global market correlation. And it's really just a fancy way of saying that big economic forces, and maybe more importantly, investor feelings, that sentiment, don't just stop at a country's border. A huge move in New York will absolutely create ripples, if not waves, in Mumbai the next morning. So, let's look at our first pillar, and it's a big one: the Dow Jones Industrial Average. You really need to think of the Dow as the market leader, you know? It's that global benchmark that gives us a read on the health of the U.S. economy, which in turn tends to set the tone for market sentiment pretty much everywhere else.
And here's where it gets really interesting. You can see how this plays out directly. So let's say a powerful bullish engulfing pattern forms on the Dow. You know the one, where a big green candle just completely swallows the previous red one. Well, there's a really high chance that's going to spark some positive sentiment for our Nifty the very next day. And on the flip side, if you see a shooting star on the Dow, that's a classic reversal warning, and you should see it as a major heads up for the market back home.
So really, the main takeaway here is incredibly simple, and that's what makes it so powerful. As a general rule of thumb for the market's overall direction, just remember this: Dow leads, Nifty follows. It's that simple. Keep your eye on the leader, and you'll have a much better idea of what the follower is about to do. Okay, so the Dow gives us the big picture. Now let's get a bit more specific with our second pillar, the Nasdaq. Because it's so heavy on tech stocks, the Nasdaq is like a direct pulse for the entire global IT sector. It gives us a much more focused, much more targeted signal. And this is where things get really granular for us. If you see a hammer pattern pop up on the Nasdaq, that classic sign of a potential bottom, it's often a signal of upcoming strength in Indian IT stocks. But if you spot a big bearish engulfing pattern, whoa, that's a huge red flag for the whole sector. I mean, if you're trading stocks like TCS or Infosys, this kind of insight is pure gold. And just like with the Dow, we've got a super simple rule to remember here. When you want to understand what's happening in the technology space, just think Nasdaq equals tech trend. Its direction is a massive clue about where Indian IT is probably headed. All right, on to our third and final pillar, the dollar index, or DXY. Now, this one's a little different. We're not looking at a stock market anymore. We're looking at something even more fundamental: the actual flow of money. The DXY measures the strength of the US dollar against a basket of other major currencies. Now, here's the part you absolutely have to understand. It has an inverse relationship with equities. They move in opposite directions. So when the dollar index prints a big bullish candle, meaning the dollar is getting stronger, big international money tends to flow out of emerging markets like India, and that makes our stocks weaker. A bearish candle, meaning a weaker dollar, does the exact opposite. It often makes our markets stronger. I know this one can feel a little backwards at first, which is why this little phrase is so important. You have to burn this into your memory. Dollar up, equities down. It's a simple, powerful rule that helps you understand the hidden currents of capital that are moving the market. Okay, so we've got our three pieces of the puzzle. We have the Dow for the overall market direction, the Nasdaq for the critical tech sector pulse, and the dollar index to track the flow of money. Now for the really cool part, let's combine all of them into a single cohesive strategy you can use every single day. Think of this as your pre-flight checklist before you hit that buy or sell button. Step 1, glance at the Dow. What's the general mood? Step 2, track the Nasdaq. What's the powerful tech sector up to? And step 3, check the dollar index. Where is the big money flowing? When all three of these line up with the candlestick signal you're seeing on your own chart, wow, your probability of a successful trade just skyrockets.
And this is the ultimate mantra that brings it all home. It's the one sentence to remember in the heat of the moment when you're about to make a decision. Say it to yourself. Dow guides, Nasdaq drives, dollar decides.
So, what's the big takeaway here? It's that adding this layer of global correlation isn't just a nice to have, it's practically a necessity in today's market. Using these three indices gives you this incredible multidimensional view of what's really going on. It helps you confirm your signals and, maybe most importantly, it helps you sidestep those really costly traps where a local chart signal just flat out lies to you.
And that really brings us to the final question. With a framework like this, you're not just looking at lines on a screen anymore. You're equipped to see the hidden forces that are actually moving the market. So, are you ready to stop just seeing candlestick patterns and start truly reading the global story that the charts are telling you?